had the financial crisis in 2008, so we'll pick up our play in the first act. We've had the meltdown of Bear Stearns and Lehman Brothers in the summer of 2008. Now the Congress is debating what to do about it. How do we respond? The Bush administration has put forward an idea, this Troubled Asset Relief Program, TARP, and the Congress is debating it. We pick up our play in the first act. I have a job working in the U.S. Senate, working for Senator Pete Domenici, who has a prominent role in the Budget Committee. And so we're discussing the opportunities to deal with how do we respond to a financial crisis? How do we, we've had collateral calls on the banks. Bear Stearns has gone down. Lehman Brothers have gone down. AIG is going down. How do we respond? What do we do? So the Bush administration sends up a package of $700 billion and says this is the right answer. And so Congress right now is struggling with the challenges associated with taxpayer bailout or financial ruin. And the trade-offs are, it makes no sense for us to, we don't want to bail out banks for taking risks or any other financial institutions. And, we're thinking about what our options are. Very few options actually available. It's vitally important to step in and to provide the relief going forward. So the TARP program provides assistance to the financial services firms, and in particular in response to the mortgages, because we're trying to stop the bleeding in the home crisis. Where this whole crisis originated in the subprime. We've provided assistance to automakers, and we've provided assistance to AIG and some other financial institutions. So that was an interesting perspective. What do you do? How do you respond to this crisis? The next step in the crisis, and I moved in 2000. So maybe in Act 1 we're still in the response mode. So 2009 we go forward, the G20 nations come together, and they all decide that, yes, we need to develop a consistent set of reforms, global reforms, for the entire industry to respond to achieve more transparency, better risk management, and more efficiency in the market. So fast forward, now I've taken a position, I've been appointed by the President, taken a position at the Commodity Futures Trading Commission, where I've met John Lothian. And the issues that we're dealing with now are the legislation following on to the TARP relief. So the relief has been provided. It has now been a year and a half, and we're thinking about the financial reforms. Congress is beginning to pass these reforms and debate what the right solutions will be. So Congress in July of 2010 passes the reform package known as Dodd-Frank in the United States. There are similar reforms in Europe and reforms in Asia as well. So we do actually have the G20 objectives of a global package, and they focused on 4 major reforms. One is data. Make sure that all trades are reported in the market, and this is in the uncleared derivatives market. So report all trades. Clear all trades that should be in a clearinghouse. Now, not every trade should be in a clearinghouse. They're risk management entities, but being able to manage and understand risk is a very important issue. The other one is trade execution. Put as many trades as appropriate on a trading platform. And the fourth element is to take the uncleared market and put it in and make it more expensive, essentially, raise the price of the uncleared market, so it serves as an incentive to clearing. So we take those, Congress builds a package around that, and then they hand it off to the regulatory bodies to implement this reform. Now, this is a massive task. It's over 1,000 pages. The CFTC alone had the duty of responding to Title VII for the most part, all of Title VII and a couple other titles. And so we go about unpacking the 4 elements that the G20 kind of outlined. So we begin to debate, in what order? How do you attack this problem? What should it look like? Because it is not the futures market. It is a market that is traded a lot in far less standard packages, and it is a much larger market. It's a $700 trillion market in notional value, gross notional value. So we're trying to figure out how we adapt this so we don't totally wreck the market, allow people to continue to use this market for the key purpose is risk management and hedging risk. It's a global market as well, so we have to do this in a global package that continues to create liquidity and make sure that all participants can continue to hedge their risk is kind of the fundamental purpose of this market. And you're talking about not only major banks, you're talking about raising money out of China and Asia. Where do they get the money? They have to come to New York in different currencies. They want to be able to raise money to develop Southeast Asia and China, for example. Companies use it when they have international operations to manage their risk. They have to pay their employees, right? So if you're paying in dollars, if you're raising money in dollars, but you have to pay your employees in sterling, how do you manage that? Well, you want a derivatives contract that can help you manage that risk, or if you're raising money in other countries. So these are all the things that you're dealing with and corporations are dealing with. So we need to protect this market. So at the commission, I'm at the time one of 5 commissioners, and it's a bipartisan panel. And it's quite a challenging job. When I first took the job, people said, Scott, it hasn't been all that busy. You might want to think about getting a hobby. Well, the financial crisis hit. We had to implement Dodd-Frank. I had no need for hobbies. I had no time for hobbies. It was a very full-on experience, and we were trying to get through a massive amount of rulemaking in a very short amount of time. So July 2010 is when Dodd-Frank passes. We are handed the document. We are still dealing with that document and still working through that implementation. And it still is being implemented. The final rules in the United States are just being implemented, and in Europe they'll be implemented by 2018. So the rulemaking out of all of this has taken nearly a decade once the financial crisis. By the time it's fully complete, the last European rules, the MiFID rules, will be implemented in 2018, 10 years after the financial crisis. So what did I do in the 4 years that I was a commissioner? Well, we voted on 65 final rules. We worked to make sure that we understood this market and tried to project how it might be traded. We defaulted largely to the futures market. We said, all right, we know what the futures market is. Let's put a lot of this stuff into clearinghouses. Let's see if we can put as much stuff as we can on trading platforms. Let's make sure that we report all trades. So we went about implementing this, and we put out, there's a process to the federal rulemaking. You put out proposals, you get comment, you revise those rules, and you move forward with the final implementation. That took 4.5 years to get through it. I think I was the only commissioner, or the commissioner to vote on the most final rules, because I was there from 2009 to 2014. And it was a very interesting period. We're trying to understand how we make this work, the regulatory implementation. We not screw up the market, but we're guessing at a lot of these questions because we didn't have data about the market. We didn't know exactly how it would be sized. We didn't know what should be in clearing, and we had to trust that the market forces were going to, that we could hand this off to the market and they could implement these rules. So let's go to the next act. So where do we stand in terms of the next act? That's Act 3. And I've now switched jobs. I've taken the job as CEO of ISDA. And it is not a skin disease. It is a very important institution, the International Swaps and Derivatives Association. And now I have kind of the responsibility of working, and it's a trade association, so we bring the industry together. We have 860 members in 67 countries, and we're trying to take all of these rules that all of the different regulators have passed, make sense of them, and help the industry implement them in a cohesive and coherent manner, and try not to lose money doing it. So the challenge of now handing off the regulations, Act 3 is the implementation. And now we've been implementing it since midway through the process. Some of the early rules came on over 3 years ago in the United States, 4 years ago, I guess, now. So we've been reporting all trades. Data is important. We understand the market. So all of the trades being in the derivatives market are now being sent to trade repositories, which regulators can mine and better understand the market and manage risk. We have had clearing in the United States, mandatory clearing requirements that you clear all products, and we clear today all interest rate products in 4 currencies and all credit products in indices. The SEC had some responsibility for doing the other credit products. They have not finished their work. We have trade execution platforms in the United States. William kind of talked about CME's role. These are slightly different. The market is not the same as a futures market. These are not standard contracts CME thinks up and then puts out for trading. These are these are contracts that two entities come together and say, I want to exchange this level of risk. So it is a bespoke market, but that doesn't mean it can't be put on a platform. More standardization is coming to the market. We're trying to think about how, with clearing and trading, how you make these things work for the market. So you have slightly different platforms, and we've had trade execution in the United States for about 3 years. The last element is the non-cleared margin rules, and those two are having a sea change, and those have only been implemented in the market in the past. I guess September 1 is when we first implemented those rules. So you can see that over the past 6 years, it has been a monumental challenge to kind of digest, comment, and implement these rules. So where do we stand? The 3 acts have passed. Let me give you a perspective on where I think the challenge is. Now, I mentioned one element to all of this, and that was the cross-border element, and that's very important because we signed up back in 2009 for a cross-border, a global solution to all of this. And while we have been developing the rules, the execution has been far from spectacular. The cross-border harmonization is a bit of a wreck. Let me give you an example. In data, we have probably 20 regimes reporting data, and all 20 of them do it differently. So you're not living up to the dream that the regulators had at the time, which was to being able to look at data from a global perspective to identify risk. That's very important. That still needs work to do. Clearing, that has actually gone quite well. The industry is actually leading and is ahead of the market today. And is doing a very good job in terms of moving more products into clearing. That's risk management. That's greater efficiency. We'll leave the debate about managing our risk in CCPs. That's maybe for a longer topic, but you now have created these very systemic, importantly, risk management tools, but you need to make sure you have good oversight over them so you don't create another crisis. Some of the trading, the jury's still out. We do not have trading rules in Europe. You have trading rules in the U.S., so you haven't quite solved that solution. We don't know if they're going to work well, but early on it looks a bit problematic from if you don't get the rules right, you have 2 liquidity pools, and you're not going to be able to get the same efficiency as you'd like. The capital rules are for non-cleared margin trades are beginning to just set now, and they're going to have huge ramifications on the market. ISDA has been taking a key part in that, developing solutions around that market to make sure that you have efficiency as well. So the jury is still out on whether this has been a total success. We have made some significant strides. The industry is working very hard to implement all of these rules and to make it cohesive. And I think you're going to see a continual evolution. And I think that the final jury will not come in. The reviews on this 3-act play, will not come in for at least another 2 years until we see the final U.S. and European rules fully implemented, and then see if we can harmonize those rule sets. So it may surprise you to know that it has taken this long, and the largest amount of time has been the regulatory impact. But it is a very important element to this. Most of the time has been taken is to make sure that we get comment from the industry. Despite getting comment from the industry, however, you would think they would get some of the rules a little more coherent and cohesive, but it is the nature of a global regulatory structure. So I think my perspective on this has been quite interesting. 2/3, or at least 2 acts of this play, I've been in the official sector and having a front row seat to the rule development, which I would have to say is probably the most fascinating thing I've done in my career. And now the last act, I've had the opportunity of fully implementing these things, which is also actually quite important, and I'm quite pleased to be in this position to make sure we see these rules through. So that, I think, should give you a short perspective on about what will be 10 years of reform post the financial crisis, all done in 10 minutes. So there you have it. Thank you very much.